talking about finance and mortgage and homes and money. And there's some things that weren't really shouted out or talked about that we're going to talk about when it comes to mortgages and real estate and protecting assets. And one thing that Grant Cardone talked about is making money, making money. And how can we do that? How do we grow money? My name is Beth Roberts. I am your moderator for today. I just want to share a few things about myself. I am a licensed finance professional, and I belong to a group of committed licensed finance professionals who are on a mission of no family left behind to end poverty in our country. And we do that by educating one family at a time. And tonight, what we're going to be educating on is protecting those assets. I'd like to introduce you to two very beautiful women. My daughter, first, is Jaren Brown. She is an amazing individual. She is a mortgage professional. She is a credit professional, a finance professional. She's a professional mom. She has 4 kids. She's running 4 businesses and a full-time job and managing her husband and her household. And trust me, all the finances. Hey, give it up for Jaren. And next, someone very near and dear to my heart. She is my mentor. I look up to her for practically everything. And I'm just so grateful for her leadership and mentorship from the mouth of babes. She's like 10 years younger than my own daughter and has taught me more in finance in less than a year than I've learned in the 57 years on my planet and of my existence. And that would be the one and only, none other than Carol's daughter, Candiss Hart.
All right, so tonight we are covering mortgage protection through insurance, ensuring protection for your loved ones and your assets, also known as your home or real property. So I wanted to start off with just a brief overview of who we are. Aegon was actually founded in the Netherlands in 1844. They were the #1 financial firm in all of Europe. And Aegon is actually 200 years old. They are a multinational insurance company operating in over 20 countries. They were initially focused on just life insurance until Aegon acquired Transamerica in 1999 and identified a huge gap in services. Transamerica has been in business for 100 years now, and it's the leading American financial services company, and they provide life insurance, retirement solutions, asset management, and other financial services to customers across the U.S. And now we have WFG. This is actually who I work for, who many of us on the team work for. And we have together over 300 years of combined experience that serves as a foundation for us. So World Financial Group, also known as WFG, is an affiliate of Transamerica, and we are a multi-trillion-dollar business finance is a multi-trillion-dollar business that brings in more money than real estate and retail combined. Here at WFG, we like to think of ourselves as the Amazon of finance because Amazon lets independent sellers sell on their platform, and whereas we are all licensed independent agents and we're able to offer these services accordingly. Now, here at WFG, we actually have over 42,000 licensed WFG agents. We've helped over 4.2 million families since 2001. There has been a 7.34% increase in business. This is like actually a recession-proof business. When everyone else was going through market crashes in 2008 and even this most recent COVID pandemic, our business was still increasing. We have over 94 entrepreneurs who are earning at least $1 million in sales since 2001. Our home office has 259 employees, and we have over 77 product providers. So here at WFG, we are a distribution platform where people can learn, become licensed, and help people grow money. And we also like to teach people how money works. We offer various financial products, as you see here. Some of these providers you may be familiar with, like Nationwide, who's on your side, Transamerica, Pac Life, Vanguard, and so forth. And then we also have strong financial backing and resources to offer. And here you may recognize some of the people here, but we like to work hard, but we like to play harder. So here you can see our leader, Johnny, in a lot of these pictures. And then you might also recognize Eric Thomas, John C. Maxwell, Magic Johnson, and others. So with that being said, let's go ahead and get started. So, what is mortgage protection insurance? It pretty much is a life insurance policy that can pay off your mortgage, ensuring the protection of your family's home. So, the decision to get life insurance is often influenced by a major life milestone, right? Whether you just got married or you're becoming a parent and you gain a new dependent who will rely on you. Life insurance also comes into play when you take on a large financial obligation like buying a home and obtaining a mortgage. Um, Life insurance mortgage protection is a reliable way to establish financial stability to secure a home for your family. And it can help ensure that the financial debt you owe towards your home can be paid off if something happens to you. Now, I want to break down PMI versus MPI. I know probably a lot of people are familiar with PMI, which is private mortgage insurance. For example, if you have your own mortgage and you put down less than 20% on your home, you absolutely had to buy this. But let's go ahead and break it down even further. So with PMI, this actually protects the lender, ensuring they'll get their money back in case you default on the loan and you have to put your home up for a foreclosure sale. This actually increases your monthly mortgage by hundreds of dollars each month. It does not protect you in case you lose your job. It does not protect you if you become disabled. And it does not protect your home in case you die. Now, mortgage protection insurance, MPI, on the other hand, protects you as the borrower. It's voluntary based on your age and your lifestyle. It protects you in case you lose your job. It does include disability and other unforeseen events. Benefits of mortgage life insurance. So, your home is more than just a roof over your head, right? It's a place where your family will grow as your life evolves. And it makes sense to have a policy in place ensuring that your family will be able to keep the home no matter what lies ahead. We at WFG can help you select the coverage you need that will best benefit, that will be the best fit for your needs. Using life insurance to cover your home mortgage, there are times where you may need to combine insurance policies in order to meet your specific needs, such as paying off your mortgage. So, some of those benefits include a combination of coverage types where they may provide more benefits than a single product solution. So, for example, that will better protect your home in the event you pass unexpectedly. Another benefit is the balance you owed on your mortgage would always be covered by the combination of one or two life insurance policies. And using life insurance for mortgage protection can alleviate the risk of someone being left with an unmanageable financial burden. I don't think any of us here, whoever bought a house, thought like, oh, if something were to happen to me, how would my family pay for this home? Would they have to sell it? Would they lose it in a foreclosure? I don't think any of us ever want that to happen to our loved ones. Another benefit would include customizing your coverage so it can provide short-term protection when your mortgage amount is highest and long-term protection to cover the entire duration of the mortgage. And the combination approach of having a short-term and a long-term policy can actually work within your budget, offering you a lot of flexibility. And it can be designed to cover all mortgage payments. All right, using life insurance to cover your mortgage. This is how it works. So think of it this way. When you buy a home, you can take out two policies. A permanent policy that will provide the amount of long-term coverage that best fits your situation, and then a term policy that will cover the balance of your mortgage for a short term, anywhere between 10, 15, or 30 years, when the amount owed will be its highest. So, two insurance policies, permanent would provide you long-term coverage, and then term could cover the balance of your mortgage. 15 to 30 years, I guess if you're doing FHA or conventional, or even 10 years is an option. So the term policy would last for a long enough period and carry a high enough benefit to guarantee that your family will always be able to pay off the mortgage should something happen to you. And then your family would be able to utilize the benefits at their discretion, and they can use it to pay off the mortgage to its entirety, continue making the mortgage payments, or to cover another need. And here's some frequently asked questions about mortgage protection insurance. How does using life insurance to pay off your mortgage work? Well, a life insurance for mortgage protection is a term life policy designed specifically to repay mortgage debts and associated costs in the event of the death of the borrower or borrowers. Does life insurance help with the mortgage if something happens to me? Permanent life insurance and term life insurance can all provide a means of paying off your mortgage. With each type of insurance, you pay regular premiums to keep the coverage in force. Does life insurance pay off your mortgage? Life insurance can be used to help your dependents pay your mortgage if you die. This type of strategy involves life insurance, is often sold as decreasing term policy, which Candice will cover momentarily. So your payout reduces as you gradually pay off your mortgage. A life insurance claim is typically paid out as a lump sum. What happens if I die with a mortgage? If upon your passing, no one has been designated to inherit the loan and no one makes mortgage payments, the lender will still need to collect on the debt. The lender usually ends up selling the home to recoup the debt, but if someone intends to keep the home, they must continue to make mortgage payments. And is it okay to have multiple life insurance policies? There are no legal limits as to how many life insurance policies you own. Many people have life insurance coverage through their employer, which is often known as group. We don't really like that type of policy here, but they often may have that in addition to their own term life policy or permanent life insurance policy. However, each policy needs to be underwritten and may impose a limit. Bearing that information in mind, that if you have financial obligations beyond the mortgage, you probably want combined policies to cover additional expenses. And that would include childcare, if you're saving for retirement, or maybe you have medical expenses. All of that needs to be considered when you purchase your policy, and your coverage should take the entire range of your financial needs into account. And with that being said, I'm going to pass it over to Candice.
That was amazing information, Jaren. I love the fact that this type of insurance can be positioned strategically to cover different needs for a household altogether. And then when you think about real estate in itself, when you think about the mortgage, a lot of people have a misunderstanding or just a misconception in general on ways to do that. They think it has to be basic mortgage insurance, and that's not at all true. Although I think it's really important to have several layers to cover a certain base or cover several bases, I think it's important to diversify altogether anyway. So I'm going to actually go into more detail on the topic of how decreasing term insurance can be properly positioned as mortgage protection. Because just before I share my screen and go into some details, I'm going to give you guys some visuals in a second. I want you guys to just take a basic concept of a mortgage. When you pay a mortgage, you're paying your mortgage down, right? Because you have this X dollar amount where you owe on a property, and your goal is to pay it off month by month, right? With a little bit at a time. Well, as you pay that off, you also want to have some type of protection in place in case you're no longer there to pay it off. So, what happens if I'm the breadwinner of the household? I'm paying the mortgage, but all of a sudden I pass away. And maybe it's a freak accident. I could pass away in a car accident, God forbid, knock on wood, right? I don't want it to happen. But sometimes life happens in unpredictable ways. Unexpected things can happen. That's where insurance is our best friend, because it protects us when we have unforeseen events that could really happen in our lifetime. This kind of insurance could take place of me, because now I'm no longer alive to pay that mortgage every month, but my family's still needing this household. We still want to keep this household in our bloodline for generational wealth, so on and so forth. Now this insurance policy can replace me as a person, give my family the money that I would have been paying out of pocket. It will give them this money so now they can pay the mortgage in replace of me, or in my absence, I should say. Okay. So I'm going to share my screen to give you guys some visuals and some more details on that. And then I'll see if you guys have any questions for me once I give you some visuals. Let me know if you guys can see a whiteboard on my screen.
Yeah, we see it.
Okay, but I don't. Give me a sec. Okay, here we go. I'm gonna get a full screen. Okay, so Term insurance, we're pretty clear on the fact that it's temporary, which means it's not going to last forever. It has an expiration date. The longest amount of time that you can have on a term insurance policy is 30 years. So I'm going to use the maximum length of time with the term policy for this example. Okay. And guys, I'm going to relate term insurance to real estate right now. Term insurance is like renting an apartment. It's really no different. So take an example of you renting an apartment. Let's say you rent an apartment for 1 year's time. When you rent that apartment, you sign a lease, and that lease is good for 1 year's time. When that 1 year is up, you either have to leave the apartment or you have to reapply to extend your lease, right? And there's a few things that can go into account on whether or not you'll get approved the second time around, because things in your life might have changed. Your credit score could have changed, your income could have changed, a lot of things could have changed, right? Same goes for a term policy. But before I get into that, let me just give some basic demographics of this pretend person that we'll talk about. I'll use someone that's 30 years old, okay? And let's say this is a female, non-smoker. Let's say she's looking to get $500,000 with this term policy, okay? And she's looking to get this for the maximum amount of time she can get for a term policy, 30 years, okay? Based on her age, based on her health, based on her gender, and even based on the state that she's living in, she gets quoted for this policy to cost her about $100 a month, just for example, okay? Now, guys, 30 years from now, it's a lot that could change. A lot of things that are very unpredictable. Things could change with her health. What if she has a heart attack in that 30-year time period? What if she has a child in that 30-year time period? What if she gets into a car accident? What if she actually becomes a smoker, right? A lot of things could happen in that 30-year time period that are just very unpredictable and we can't say for sure. But God willing, the one thing that we can say for sure is she'll no longer be 30 years old. She'll be 60 years old 30 years later, right? So let's say she's 60 years old now. She's still a female. And let's say she didn't start smoking. She's still a non-smoker. And now this policy has expired because it was only good for 30 years. Remember, she's 60 now. She wants to reapply for the same exact type of coverage. So another $500,000 policy. And she wants to get this for the same amount of years that she had her previous policy for, a new 30 years. Okay. The biggest thing that'll change in this example is her premium won't be $100 anymore because she's no longer 30 years old. Now she's 60 years old. And naturally, some health differences have taken place. So her premium, it could go as high as $1,000 a month for the exact same type of policy. So what if this 60-year-old woman now can't afford $1,000 a month for a term policy? This could become a risk because now she can't afford the kind of coverage that she needs. Had she had gotten permanent coverage at the time, things would look different. So I don't want to beat up on term insurance. That's not my goal right now. But I want you guys to just see that if you only have term insurance, it could defeat the purpose of having insurance for your life as an end goal, right? Because it could expire and there's things that could make a difference on whether or not you can afford it the next time around, or God forbid, maybe not even qualify the next time around. What if the health changes that happen within this 30-year time frame were not in her favor? Okay. Now put that aside and now bring the conversation back to the mortgage topic. Term insurance does serve a really good purpose. When someone has, you always want to make sure that someone has permanent insurance in place for sure, because you need something for your entire duration of life. But now when it comes to the topic of protecting your home, this same 30-year policy right here could cover a mortgage that maybe she owes $500,000 on that house. Because mortgages, they're written in terms of time as well. You can sign for a 10-year mortgage. You can sign for a 15-year mortgage, a 20-year mortgage, 25 years, 30 years. 30 years is usually the longest that is normal, I would say, in general sense of speaking, when it comes to mortgages, because the idea is in 30 years, you need to have this house paid off, right? So if I have to have my house paid off in 30 years and I owe $500,000 on it, and I'm the breadwinner of the house, I'm the one paying the mortgage, I want to make sure my spouse, my kids, my family, if I pass away, they can inherit that $500,000 and be able to pay that house off if I'm no longer alive to be able to pay that bill myself or help pay that bill myself. That's the idea of it. Okay. Now, with decreasing term, the coverage amount decreases every month that your mortgage is paid. Because if you owe $500,000 this year, the idea is you shouldn't still owe $500,000 next year. You should have made a year's worth of payments this year. So next year, what you owe should be less, which means your term policy doesn't need to be $500,000 next year either. Because the purpose of it is to match whatever the amount is that you owe for that mortgage payment. So as your mortgage payment decreases, because you're making your payments on time, you're making that progress, things are going good, your term policy, your decreasing term policy will also decrease with that. Okay. Um, so yeah, that's the number one example I would give in regards to positioning term insurance for mortgage protection. It doesn't have to be straight up basic traditional mortgage insurance. It can be decreasing term and or just basic term insurance that can position your family to have additional and or alternative types of mortgage protection. Yeah, I wanted to give you guys a visual of just what it looks like as the years go on, because if it's another reason outside of a mortgage, it's definitely necessary to maybe expand on the kind of protection, right? Yeah.
I just wanted to say that I've never seen this, like not presented in the way that you guys did it. And I took a lot of pictures because I think we all have clients that this information will benefit them. My only regret, like with everything, is how many people didn't get it. But that just means there's more clients for us. That's all.
What that means, and that's why we are committed licensed professionals that are just determined to educate as many people as we can.
That's awesome.
Okay, Candice just dropped it in the chat. She said, correction, premiums do decrease with decreasing, just as they also increase with increasing term. So that's great to know. That's really great to know. This was personally just a really important topic for me to cover, just because, you know, people who do get loan products to buy homes, they're never taught about MPI. They're always like, oh, you need
Yes,
MIP, mortgage protect. I'm sorry, PMI. You know, because that's just what the loan company wants them to have to protect themselves. But no one ever thinks about, well, what about me, protecting me in my home in case something happens to me. So I just wanted to share this, and hopefully it resonated with some of you.
I'm sorry, I just wanted to piggyback on what Jaren just said, because a lot of times when people are purchasing homes, especially first time home buyers, it's their first rodeo, you know, and they're kind of just going with whatever they're being told by either their agent or their loan officer, um, so on and so forth. And in a lot of those cases, it's not that those people in position are giving them the wrong information, but sometimes they're not giving holistic information because they don't have the kind of licenses that we have in this industry, letting them know how it's important to protect their families and their homes too in other ways. So just shedding light on the holistic approach to it is key. Not to say that the PMI isn't necessary. I think it's necessary to have both. And that's what I meant with the layers analogy that I gave. Have the PMI in place, but then have this in place outside of it. I didn't even get a chance to touch on how the living benefits within a term policy can become income replacement for, because if I'm the breadwinner, let's say the car accident doesn't kill me, I live, but now I'm in the hospital for a year. Maybe I get cancer. Maybe I need chemo. Like, these are things that can really take away from your financial house. And that financial house could have been the same money I was needing to pay that mortgage or to pay those bills. So now, if I have living benefits on top of my term policy, as well with the permanent policy, but let's keep the conversation on term policy. Now those living benefits, it's like I turn it on like a light switch, and now the insurance policy will pay me a certain amount of money every single month instead of me having to figure out where I'm going to come up with this money to pay the mortgage because we still
Yep.
need to keep the roof over our head.